The objective of this video is to introduce the concept of macroeconomics to the students and explain the main component of macroeconomics, that is GDP, also called gross domestic product.
Good morning everyone. Today I Ankita is going to start your new session with your first book, that is macroeconomics. Before starting with the macroeconomics, you must be clear about the basic concepts and principles of microeconomics, which we have already read in your 11th grade. As we have read in microeconomics that it basically relates to the economic problems or the economic transactions which are exchanged between an individual consumer and individual producer. But if we talk about macroeconomics, it basically relates to the economic problems on a large scale or at the level of an economy as a whole. But we can't say that the microeconomics is less important than the macroeconomics. Now here comes the basic definition of macroeconomics. Now you must know that the macroeconomics is comprised of the two terms, that is macro and economics. The term macro is derived from the Greek word makros, that is makros, which means large. Therefore, in macroeconomics, we study the economic problems related to the large scale or of an economy as a whole. Along with that, we can also write the basic definition, that is, macroeconomics is the aggregate of all the behavior that happens in microeconomics. For making this concept more clear to you, I would like to give you an example. For example, like in the recent situation that is going on of coronavirus, like I am demanding a sanitizer, and as we know that the demand for sanitizer is very much nowadays in the whole nation too. So in case I am talking about microeconomics, I will take only the individual demand, that is of a single consumer, that how many sanitizers a single consumer is ready to take at a particular price. But if I talk about the demand of the sanitizers of the whole nation or of the whole economy, that will come under the aggregate demand, and that is the basic concept of the macroeconomics. Similarly, you can take another example of the mass, or you can take the basic examples like that of the eatables. Therefore, to make the sense of things happening at the national level, macroeconomics was introduced. The concept of macroeconomics was given by Adam Smith, who is also known as the father of modern economics, as he has wrote the book The Wealth of Nations, in which he has described the importance of the modern economics or the macroeconomics, because he raised a concept that how the wealth of the nations can be measured or calculated, or what is the base of saying that an economy is better than the other one. These are the major components of macroeconomics on which this whole subject is based, or we can also say the scope of macroeconomics or the field of macroeconomics. There are various concepts like national income, inflation, unemployment, world trade, foreign exchange, government budget, GDP growth, etc. All these concepts we will study in this book of yours. Now here comes the most important concept of macroeconomics, that is GDP or the gross domestic product. Many of us must have heard about this term but may not know the meaning of this basic term, that is gross domestic product. So firstly, we need to understand about this term. So the basic definition is that it refers to the total market value of final goods and services produced within a given country in a given period of time. This term GDP is given by a famous economist, Simon Cousins, and Adam Smith also took it as a base to measure the wealth of various nations and to compare the two economies, or to rank an economy among the whole world. Now we will study each and every term included in this definition. And the very first term among that is the total market value. So how we will get the total market value? For that, we need to get the total market price of the various products produced in a single country. For example, let's say that in our country, that is India, a number of products and a variety of products is being produced. But by adding only their quantities produced, we cannot get the exact value of the goods being produced. Therefore, we need to know the market price of those products, which we will add up, and what we will get is the total market value or the total market price of the goods being produced. For example, a car is produced and the market price of that car is rupees 5 lakh, and along with that I need to add up the cost of the laptops being produced, and let's say the cost of a single laptop is rupees 50,000. So if we add both the values, what we will get is the total market value. The next basic term included in this definition is final goods and services. For that, firstly you must know about the difference between the goods and services. The goods are the tangible products which we can see or which we can touch, and on the other hand the services are intangible in nature. For example, the goods may include any kind of product which we are using in our day-to-day life. For example, any kind of eatable, any kind of machinery, etc. But on the other hand, the services may include the banking services, the insurance services, the warehousing services, etc. But another term, final, is also there along with the goods and services. So the final goods basically includes those goods which have crossed the boundary line of production. Let's say for producing a single machinery, we need to buy various spare parts of that machinery. So what the spare parts are? The spare parts are the intermediate goods, and the machinery which is produced is known as the final good. Similarly, let's say that in producing a single car, what we need is the plastic we need the steering material, we need the tires. All that is the intermediate goods which we need to assemble and make a final good, which is a car. So the value of the car, let's say, is 5 lakh rupees. We will only include the value of the final good, that is of the car, which is 5 lakh rupees. But we will not include the value of the intermediate products like that of the steering, tires, etc., because the value of those intermediate goods has already been included in the final good, that is rupees 5 lakh. So that's why we take the concept of only final goods and services. We will not include the intermediate goods and services or the raw materials which are being used for producing the final goods and services. What this next term produced means? Produced means that the economic activity which you are considering in GDP must include the production of any goods and services too. For example, if I am donating an amount of money to an NGO, will that be included in the GDP? The answer is no over here, because it is a unilateral or one-sided transaction, and there is no kind of production involved in that kind of activity. Similarly, if we are involved in exchanging the gifts, will that be included in the production activity? No, it will also not be included in the production activity. Further, it will not be included in the GDP. Similarly, if I say that I won a lottery of rupees 1 crore, that will also not be included in the GDP, because with the winning of the lottery, I haven't contributed to any production activity. Therefore, it comes under the windfall gains kind of activity, which will also not be included in the gross domestic product. Now, here comes the next dissection of the definition, that is within a given country, which means that whatever production activity is being conducted, it must be within the domestic territory of a country or of a nation. Only that production will be included in the term GDP or the gross domestic product. Now, this dissection of the definition, that is in a given period of time, means that we usually use to calculate the value of the GDP for an accounting year that ranges from 1st April to 31st March, or for a quarter that is basically of 3 months. So by concluding this definition, we will say that it basically refers to the total market price or the market value of the final goods and services produced within a given country, even in a given period of time. Thank you.